Good morning, students. Yesterday we have discussed the Walters approach and practicality of that Walter approach on the value of the firm or value of the price of the stock. Today we are discussing about Gordon's approach. Yesterday I have shared one assignment on Walter's approach. So you have to submit that assignment by tomorrow on a Google Classroom in Word file or PPT format, sorry. Gordon's model, Gordon uses the dividend capitalization approach to study the effect of the firm's dividend policy on the stock price. According to him, what is presently available is more preferred than what may be available in future. So basically, if we are talking about the time preference of money and time value of money, basically they preferred today's price as compared to the future price. If we are earning the same value in the future, so we'll prefer the present. So basically, if we are getting a more money in the future, then we will prefer future. Otherwise, we can prefer present only. So Gordon model assume that the investors are rational. They want to avoid risk. So basically, when we are talking about customers or when we are talking about investors, they are behaving rationally and they can spend money rationally. So they will avoid the risk. They would prefer to pay high price for the shares now which earn them a current dividend income. In the same way, they would retain their earnings if the company postponed dividend. Again, the share prices and the dividend depend upon a retention ratio. Means from the last line we can know that there is a relevant approach because the share prices are depend upon a dividend and retention ratio. So how we can find price under the Gordon model? So price is equal to earning per share that should be multiplied with 1 minus B. B stands for retention ratio. How we can find retention ratio? That is 100% minus dividend payout ratio. Divide by K. K stands for capitalization rate or rate of return required by the shareholders. Minus BR. B stands for retention ratio. R stands for rate of return on the investment. So BR stands for G also, that is growth rate. So this is how we can find the value of the share under the Gordon model. According to him, there are basically 3 points. According to him, the firm with the rate of return which is greater than the cost of capital should be higher retention ratio. Firm which have rate of return less than the cost of capital should have a lower retention ratio. The firm which have a rate of return equal to cost of capital will however not have any impact on the share value. It can adopt any retention ratio. In short summary of the above, I have written the short summary of the above. Basically, if the R is greater than K, high retention ratio should be preferred. R is lesser than K, then higher dividend payout ratio should be preferred. If R is equal to K, any retention or any dividend policy payout ratio should be preferred. So these are the 3 points you have to careful, or you have to focus on these 3 points, because in numerical we can use these 3 points. Assumptions. Basically, there are some assumptions given by Gordon. All the firms are equity firms. Basically, here there is no levered firm. Levered firm stands for they are basically not using any debt or outside borrowings. Only financed by retained earnings. The firms can get a finance through retained earnings, means internal source of finance. Means what they have retained as a profit, they can use only that profit for future financing. The internal rate of return and the cost of capital of the firm is constant. This is same like Walter's approach. Internal rate of return and cost of capital remain constant. Then next is cost of capital should be constant. We have already discussed that point in the above. The retention ratio, that is B, once decided upon, that is again constant. So retention ratio should be constant. I think these are the irrelevant assumptions, because if we are talking about rate of return or cost of capital, that can be changed time to time. If we are talking about retention ratio policy, that again changes with the changes in the scenario of the market, and we are using a debt. So first assumption is again unrealistic assumption. So that these are the criticisms of Gordon's approach also. So as assumptions of Walter model and Gordon model are same, so Gordon model suffers the same limitations as Walter's model. So there is one illustration given on that. The following data are available for Rogers Group. Earning per share is rupees 40. Rate of return on investment, that is 20%. Rate of return required by shareholders 30%. If the Gordon valuation model holds, what will be the price per share when the dividend payout ratio is 25%? So how we can apply into the numerical part? So P is equal to E, that should be multiplied with 1 minus B upon K minus BR, that we have discussed in the previous slides. So P is equal to, if we are talking about numerical part, here the earning per share is 40. So we'll write 40 instead of E. Here the dividend payout ratio is 25%. If we are talking about retention ratio, that is 100 minus dividend payout ratio. So that is 100 minus 25%, which is equal to 75%. Divide by KE. Here KE has been given, that is 30%. Minus BR. B stands for retention ratio. We have already find out, that is 100 minus dividend payout ratio. 100 minus 25%, which is equal to 75%. Multiply by R, that is 20%. So if we can find the value of the share as per the Gordon model, that is equal to 66.66 or 67 per share, or we can round it off to 67 per share. This is all for the today's lecture. Thank you very much for listening.